Thank you for joining us on today's episode of Tax Matters. I am Chamaka Ohauchi. We pride ourselves on this program as being the home for information and education on taxation. For instance, when tax experts talk, they talk to tax matters. In keeping with our DNA, today on the program, we want to dissect the Finance Act 2020. Call it Finance Act 2020 101 if you like. By way of introduction, let us remind you that in the year 2020, for the first time in 2 decades, Nigerians got a big present from the Muhammadu Buhari administration. The Finance Act 2019, which was to govern and did govern government activities in the year 2020. And the government made a promise then that going forward it would be a yearly affair. True to that promise, the Finance Act 2020 is here to support the Appropriation Act 2021. The FRS has been on the road. Leading the effort has been the Executive Chairman FRS himself, who has seized every opportunity in the last 1 month to educate and inform stakeholders on the provisions of the Finance Act 2020. The major news networks have lent their support to the communication effort. Top auditing and tax consulting firms have also not been left out. We are going to intersperse our offering today with sound bites from some of those interventions. To go back to the beginning, what are the major provisions of the Finance Act 2020? According to the Honorable Federal Minister of Finance, Budget and National Planning, the Finance Act 2020 contains 80 provisions, amending 14 tax laws in all.
The federal government proposed and passed the Finance Act 2020 to support the 2021 federal budget. The Act has introduced 80 changes to about 14 different tax laws, including the company income tax, the capital gains tax, stamp duties, Oil and Gas Export Pre-Zone Act, Customs and Excise Tariff Act, and also the Value Added Tax, amongst others. The Act has extended the corporate income tax exemption in the Finance Act 2019 for micro and small size enterprises with a turnover of 25 million naira and below or less, to include exemption from paid tertiary education tax. Also, small and medium enterprises that are engaged in primary agricultural production can now acquire pioneer status relief for an initial period of 4 years and an additional period of 2 years, making a total of 6 years. Other provisions of the Finance Act 2020 include 1. Exemption of all low-income employees who earn the minimum wage from personal income tax. 2. A 50% reduction in the minimum tax levied on companies from 0.5% to 0.25% of gross turnover less franked investment income. 3. Reduction of import duty on tractors from 35% to 5%, mass transit vehicles for the transport of more than 10 persons, and trucks from 35% to 10%. And the reduction of import levy on cars from 30% to 5%. Exemption of commercial airline tickets, commercial aircraft spare parts, animal feeds, rental or lease of agricultural equipment for agricultural production purposes from VAT. There are also a lot more exemptions for VAT in the Finance Acts 2019 and 2020. Other reforms in the 2020 Finance Act are targeted at supporting the implementation of the 2021 budget. This includes restrictions on the cost-to-revenue ratios of government-owned enterprises to increase operating surpluses remittances to the Treasury. Reforms extended also to the Procurement Act for the first time to cover the judiciary and the National Assembly, as well as shortening the procurement periods increasing procurement mobilization fee thresholds from 15% to 30%, and providing for e-procurement.
The Honorable Minister was speaking at the webinar organized by PwC on the Finance Act 2020, to which we will return presently. But permit us to begin with the webinar organized by Pedabo Associates, which was the first in the series. The keynote address at that webinar was delivered by the Executive Chairman FRS, Mr. Muhammad Nami.
It is heartwarming to note that the federal government has kept up with this yearly ritual rite from the introduction of the Finance Act 2019, which brings to the fore fiscal policy to direct economic operations. The Finance Act 2020 makes some changes and improvements to various laws of the Federation. Prominent among the changes that will be discussed today by the Finance Act includes the exemption of companies with less than 25 million naira turnover from payment of tertiary education tax, to reduction of minimum tax from 0.5% to 0.25% of gross turnover for a limited period of 2 years. Power of the Federal Inland Revenue to fully automate tax administration processes for information gathering, including assessment, collection and accounting of taxes in Nigeria. Donations made in cash or in kind to the government in respect of any pandemic or natural disaster are now tax deductible. Exclusion of land and buildings, money and securities from the definition of goods and services for VAT purposes. Downward review of excise duty rates on tractors and motor vehicles for transportation, as well as the duty-free importation of aircraft and its parts for commercial airlines.
Panelists at the webinar included Mr. Matthew Bojumbola of the FRS, Dr. Bode Oyetunde, Senior Special Advisor to the President on Finance and Fiscal Policy, Mr. Kola Marsha, Mr. Babatunde Majiyabe, Mr. Albert Folorunshaw, and the Executive Chairman LRS, Mr. Ayodele Sober. Mr. Albert Folorunshaw is the Managing Partner of Pedabo Professional Services. With regard to amendments to the various laws,
the important point that to start with is the fact that the effective date of the Act was included in the Act, which is the major departure from what we used to have, and we're having controversy here and there. So it took effect from 1st of January 2021, as stated in Section 81 of the Act. When it comes to capital gains tax, there are three specific provisions that were amended, some of which are quite straightforward, particularly in terms of compensation for loss of office. We clarify that a maximum of 10 million is exempt, and that anything on top of that will be liable to CGT. And it is the company paying that will now be responsible for remitting to the appropriate tax authority. Again, because a lot of people make disposal during the year, maybe in January, and the company's year end is December, so the returns are not due until June of the following year. So this provision tends to, fast track the payment of CGT, and have now required companies to file CGT returns twice a year, particularly where you have any disposal. If there is any disposal between January and June, it's expected that the returns will be filed by June, and then you pay to the relevant tax authority. The same thing applies if you have after June. The returns is due by 31st of September, and you also expected to pay. Section 25, you go to subsection 8, specifically donation relating to any pandemic in the COVID situation now. Okay, what government tends to try to do is to give some deduction for donation made either in cash or in kind. And of course, we know that a lot of companies invested heavily in isolation centers, provision of equipment, and all that. So this provision allows you to claim deduction for the cost incurred or the one you manufacture by yourself, the actual cost of manufacture. But of course, it's restricted to 10% of accessible profits after all other deductions and donations have been taken care of.
The panel discussion was followed by a robust question and answer session.
This is the second straight year running that the government is coming up with a Finance Act. And just like we have heard from Dr. Yetunde, it's proposed that this should be a regular occurrence. What do you make of this development in the practice of taxation in Nigeria as a practitioner?
It's a welcome development. You know, in tax practice, if there is no certainty, it's always difficult for compliance, it's always difficult for consultants, and of course the taxpayer. So there has to be certainty. And the only way you can have certainty is where there are issues, they are easily and quickly corrected. For example, I've gone through the question and answer chart, and I can see a lot of people asking questions around the minimum tax. Are we going to be claiming refund here and there? That is a lacuna that this 2020 has also created, which I believe that down the line, in a few months, or the error can easily be corrected. So if we can have certainty in tax law, what I will also add here is that we must also have certainty in tax authority, so that we know who is responsible for what, who is supposed to audit what, and who is in charge of what liability. Okay, where you don't have certainty in those areas, the taxpayer is confused. The taxpayer does not know who to relate with. Okay, today RAMFAC, tomorrow Ministry of Finance, next tomorrow is Ministry of Justice. Meanwhile, Establishment Act is clear. FRS Establishment Act is clear as far as who is responsible for carrying out audits on all the tax regulations, tax laws. It should be the FRS. So we believe that down the line, all these things will be clarified, and that certainty will be there. So that is, I think, it's a welcome development, and it's something that we hope will be sustained.
On the ongoing automation of the system,
taxpayers have experienced multiple changes in the various platforms that FIS has used in the past. And these disruptions, of course, had caused some inconveniences to taxpayers, because just as they are getting used to a system, a new one is brought in. How does FIS plan to ensure that the automation of the collection and administrative system that is being promised will be a sustainable one and will be there for the long term?
The essence of this technology deployment is not only to ensure that we raise the revenue, but gives us an opportunity to provide taxpayers with the opportunity of sitting in the comfort of their houses and offices to file returns online real time, to send in, to submit documents as required by law, to attend tax audit reconciliation meetings without necessarily coming to us, to also be able to ask questions and automatically they get answers, even without necessarily having physical contact with any of our officials. So if we put all these processes in place, you could wake up in the night, not necessarily when we are open, and you type in a question and answers are automatically generated for you. So I think what we're just trying to do, in addition to try to see that yes, we have access to this big data base of taxpayers, in addition to the fact that maybe this data are able to help us in our investigative or audit procedures, so that we do not necessarily come to your taxpayers, your clients' offices to disturb you for record that we can generate online. We are also able to now do things in a manner that your business activities are no longer disrupted. With the novel COVID-19, you are exchanging fiscal documents with our staff is minimized. And whatever record you have given to us, you can also bear out witness that with the recent looting that follows the NSAS protest, some of our offices were burnt down. And with technology, whatever records, if a thing like that, God forbid, should repeat itself in the future, our records will not only be will surely be safe, and for us to come back to the tax consultant or taxpayer to ask for records in order to review their records, so I thought things like that will be minimized. All we need to do is to ensure that the technology we are deploying is only not efficient but secured in a manner that the confidentiality of taxpayer records are kept.
Thank you for staying with us. We are taking a detailed look at the provisions of the Finance Act 2020. Let's try to do a summary of the provisions. Minimum tax under SITA is now 0.25% of gross turnover. Donations to the COVID-19 fund are now tax deductible up to a maximum of 10% of assessable profits. It is now being proposed that micro, small, and medium enterprises be exempted from preparing audited accounts. Filing and payment of capital gains tax is now to be carried out twice a year. Email and other electronic means of communication are now allowed with the FRS, while the Tax Appeal Tribunal can now hold virtual sittings. The FRS has now been authorized by the Finance Act 2020 to plug into the systems of taxpayers and ministries, departments, and agencies for tax monitoring, while also deploying technology in its efforts to combat tax evasion and aggressive tax avoidance. Capital allowance is now to be granted on software. SMEs dealing in primary agricultural products are now to enjoy 6-year pioneer status. Paid employees on minimum wage, that is, those earning 30,000 naira and below, are now fully exempt from pay as you earn. Gross income for the calculation of consolidated relief allowance has been redefined. Companies with turnover below 25 million naira per annum are now exempt from paying tertiary education tax. With regard to customs and excise duties, duty on tractors is now 5%. Duty on vehicles for mass transit is now 10%, while the duty on vehicles for transportation of goods is now 10%. With regard to levies, the levy on new imported cars is now 5%, while the duty remains 35%. Airlines registered in Nigeria and providing commercial air transport services are entitled to duty-free importation of their aircrafts, engines, spare parts, and components, whether purchased or leased. Value-added tax has been removed from a range of business activities: air ticket, rent, sale and lease of buildings, animal feeds, and agricultural equipment. Unclaimed share dividends and balances in dormant bank accounts are to be transferred to a trust fund to be administered by the Debt Management Office. Entities in the free trade zone are now required to file tax returns. Foreign companies are now required to register for VAT. Under the Finance Act 2020, there is a plan to introduce excise duty on telecommunication services. We move on to another webinar, this time the one organized by Anderson Tax, still on the Finance Act 2020. Chief hostess was Yetunde Felani. Yetunde did a quick review of the provisions of the Act and matters arising.
The first issue we will discuss is the minimum tax concession. The Finance Act modified the basis for calculating minimum tax by reducing the minimum tax payable by companies from 0.5% to 0.25% of gross turnover of companies less frank investment income. Now, this reduced rate will only apply to tax returns filed for any year of assessment falling due on any date between 1st January 2020 and 31st December 2021. So essentially a 2-year period starting from 1st January 2020, that's last year, till the end of this year. Now, I think one of the main issues is that what happens to returns, that have already been filed for 2020? How would they be able to take advantage of this concession? Would they be able to apply for tax refunds? Now, another issue for consideration is the definition of compensation for loss of office for the purpose of capital gains tax. Now, the Act provides for exemption of capital gains on compensation or damage for loss of office up to a maximum of 10 million naira and an opposition of CGT on any amount that exceeds 10 million naira. The Act also places an obligation for deducting and remitting CGT on the compensation for loss of office to the payer of such compensation. This amendment seems to have resolved most of the ambiguities with respect to the provisions. However, one critical issue is, what do we even mean by compensation for loss of office? This wasn't defined in the Act. Now, which of the following will be classified as compensation for loss of office? Would it be termination of employment under a restructuring program, outright dismissal, involuntary resignation, gratuity payments? I mean, can we really classify gratuity payments as compensation for loss of office? What about terminal benefits or retirement benefits? These are some of the issues that we need to highlight, because one of the tenets of a good tax system is certainty. Now, another key issue, and this has definitely generated a lot of buzz, is the issue of computation of consolidated relief allowance for payee purposes. Payee is the pay as you earn scheme. Now, the new amendment to Section 33(2) of PITA implies that tax-exempt items should now be deducted from gross income before computing consolidated relief allowance. That's CRA for short. Now, essentially, gross income was defined, to exclude these exempted items, and some of these items include employee pension deductions, contributions to the National Housing Fund or to the National Health Scheme. The effect of this amendment, whether intended or not, is that it will result in a higher employee tax and lower disposable income for employees. Now, more importantly, employers are required to update their payee computation templates and software, and notify their employees, for the purpose of clarity. The definition of gross income, was amended, and essentially the amendment takes place immediately. So there isn't even a buffer period, for when you can say, okay, this is when this is supposed to take effect.
Time or time. This is all time will permit us to do on this episode. Of course, like we told you at the beginning, PwC also organized a webinar on the Finance Act. That and more will come to you next episode because we want you to be armed with all the information you require to navigate the field. Remember, for information and education on taxation, this is the place to be. See you next week. Thank you for watching.